So after having discussed the capital structure and the concept of debt and equity, let us now try and understand the concept of profit, dividend, and growth. Now to understand this, let us try and answer the question as to why does a person want to invest in shares? Why would you and me want to invest our money in the stock market in shares? Alright? Now it could be for the purpose of getting a periodic repetitive income. For example, let us say I invest a capital of $1,000 in shares of some good company, and then I expect that I should get some regular income from this after every 3 months or 6 months or maybe every year. And at the same time, while I keep getting regular income from this, I would want that the value of my capital should not reduce. My capital should not reduce below 1,000 what I have invested, and at the same time it should keep giving me some regular returns. Now you may call this as dividend income. Alright, we will see more about it little later. The other reason could be for the purpose of capital appreciation. For example, say I invest a capital of $1,000 in some good shares today, and then I expect that in a few years the value of my investment should become much more than $1,000. I won't mind if I don't get a regular return, but after a few years the value of my investment should be much more than $1,000 which I have invested. Okay. Now this you may call as growth of your capital. First we have seen was a regular income, which is the dividend income. In the second case, I am not expecting a regular income, but I am expecting my capital to grow. Or it could be for a combination of both. For example, say I invest $1,000 in shares of some good company, and then I expect that I should get some regular income out of it, and at the same time in a few years my $1,000 of investment should grow substantially much more than $1,000. Alright, so what I am expecting is a combination of dividend and growth. Now before we understand the concept of dividend and growth, we need to understand profit. And understanding profit is quite a complex thing. It is not so easy to calculate profit. But we are not doing a course of some chartered accountant or anything like that. Therefore, I shall try and explain to you in very simple words, in very layman's language. Alright? So now you know that any company which is producing goods or services, the company would incur certain expenditure on producing those goods and services over a period of 1 year. And then the company would generate revenue by selling those goods and services. Alright? First the company incurs the expenditure, and then by selling the goods or the services, the company generates a revenue. And in simple words, the revenue minus the expenditure is something called as EBITDA, or the earning before interest, tax, depreciation and amortization. Now if the revenue of the company is more than the expenditure, then this EBITDA will be positive. But if the expenditure is more than the revenue, then this will be a negative EBITDA and it will be called as a loss. Let us try and understand what this EBITDA is. Okay. So for a given year, let us say our company, the Five Friends Garments Limited, has earned an EBITDA of $6 million. Okay. The revenue minus expenditure for a given year is $6 million. Now, from this $6 million, the first thing that the company will take out is the depreciation and amortization. Let us say the depreciation and amortization is $1 million. Now, what this depreciation and amortization is, you may not bother to know about it at this stage. In fact, this depreciation and amortization I have explained in detail in one of my other courses that is about understanding the financial statements. But just for your understanding, let me explain to you very briefly. Let us say that the company purchases a machine or a software costing $7 million. Now this is a big amount. If this entire amount the company were to show as expenditure in one particular year, then that would be a huge expenditure and the accounts will get disturbed. So therefore, the government allows the company to spread this expenditure over a period of time, depending upon the accounting policy of that country. Let us say the cost of the machine is $7 million and the company can spread it over 7 years, and the life of the machine is also 7 years. So every year the company will write off $1 million, and that is how over a period of 7 years the company will take out $7 million. By that time the amount would have been recovered and the machine would have completed its life, so the company can buy a new machine. If it is a tangible asset like a machine, then what we are doing is called as depreciation. And the same thing if done for a non-tangible asset like a software, then it is called as amortization. So I think that much of understanding will do for the time being. But the point is, in depreciation and amortization, the company has taken out $1 million out of this 6. Okay. Thereafter, the first thing the company has to do is pay the taxes to the government. The government will not leave the company without paying the taxes. So let us say $1 million, hypothetically, this figure is hypothetical. Let us say $1 million goes towards paying taxes to the government. And thereafter, once the taxes are paid, the company has to pay interest to the lenders for the borrowed money. Whatever money the company has borrowed from the lenders, banks or other financial institutions or the public, the company has to pay interest on that for the given year. Let us say the interest paid is also $1 million. Alright. Now out of this $6 million, $1 million gone as interest, $1 million as taxes, $1 million taken out as depreciation and amortization. So what remains now is called as the net profit. So this net profit will be 3 million. Out of this 6, 3 is taken away. So 3 million remains as the net profit. And this entire net profit belongs to the shareholders. Who are the shareholders of the company? The promoters as well as the public shareholders. Okay, we have seen this already. So this entire amount of 3 million now literally or rightfully belongs to the shareholders. But the point is, will the company give this entire money of 3 million to the shareholders, or will it do something different? What should a good company do with this money? This we will discuss in the next lesson or the second part of this lesson. Alright?